We're at war, fuel prices are up, everything is getting unaffordable, and there's an AI bubble that could pop at any moment. It's fair to say the world is not in a good place right now, yet stocks keep hitting record highs. Today I'm explaining why, how long it lasts, and what it means for your portfolio. Because if you have a 401k, a retirement portfolio, or hold any kinds of stocks, you need to understand what's happening. See, the American consumer has never been this miserable. The University of Michigan has been asking people how they feel about money, their personal finances, the economy since 1966. They then turn that into a number and publish it in what's called the Consumer Confidence Report. The number in May was 44.8, the lowest it's been in 60 years of asking, lower than the 2008 financial crisis, literally during the depths of the last major financial crisis, lower than COVID, when the world shut down, people were out of work, broke, bored. We all remember how that was, yeah? Yet people feel worse today about the state of the economy, their personal finances, and their future. And yet almost every month, the stock market keeps setting new all-time highs. It doesn't make sense, is what most people are saying, but actually it does make sense. Let me explain why. There are three things propping up this market right now. Trump needs all three of them to hold until at least the midterm elections, and every single one of these things has an expiry date. So we're going to go through those three things, and I'm going to tell you what I'm doing with my portfolio, especially my retirement portfolio. So the first thing we need to fix is the question, because everyone's asking, how can stocks be at record highs when everything feels so bad? That question assumes that the stock market measures the economy, but it really doesn't. The stock market really measures the profit of about 500 big companies and where the world's money is being pushed, namely the S&P 500, which is the main stock market index. The stock market does not equal the economy, and that's the important point to take home. The stock market does not equal the economy. Actually, also forget about the S&P 500 and the 500 companies, because right now the top 10 stocks make up about 43% of the entire S&P 500. So really, the stock market is pumping because of the profit of 10 companies. That's all. Most of the 490 other companies are kind of flat right now. This is called concentration risk, by the way, because the good thing about an index is that you spread your risk over 500 companies. But when 10 of those companies make up most of the index, the risk becomes concentrated into a single thing, or 10 things. And today's concentration risk is higher than the dot-com bubble was at its absolute craziest. So when the telly says that the market hit another all-time high, what it actually means is 10 companies are having a really good year. Usually it's Nvidia, Apple, Microsoft, and 7 of their mates. Meanwhile, your rent's up, your groceries are up, and your wages are going nowhere. So that explains the core reason. But we need to talk about the three things propping up this scam market, allegedly scam market. Let's call them legs, because they're going to be kicked out from underneath the market soon, in my opinion. So leg number one is the government itself. Washington collects about $5.3 trillion a year in taxes from the American people, and then it spends about $7 trillion a year. So that's a gap of around about $2 trillion. And to make that up, the government has to take on debt. And that debt essentially gets borrowed and pumped straight back into the economy. Every single year now, boom times or not, they have to borrow trillions and pump it into the economy. Think about your household doing this, by the way. You earn $5,300 a month. You spend $7,000, and the difference goes on a credit card. But all your neighbors do that too, so everyone's doing that. Every shop on your street now thinks that business is booming because you're in there every day spending money that you don't have. That's America right now. The government is the customer that never stops buying, and the money lands in defense contracts, microchip subsidies, healthcare, interest paid to bondholders, all that kind of stuff. And every one of those dollars eventually shows up as somebody's revenue somewhere down the line, which turns into earnings, which turns into a share price going up. So a fat slice of those record corporate profits you keep hearing about is just borrowed government money doing one lap of the economy before it lands in the S&P 500, mainly in the top 10 companies we talked about. Leg 2 is my favorite because it's so shameless. Honestly, I almost feel like this should be illegal. I mean, it used to be illegal, but then there are reasons why it can be a good thing. Anyway, companies are buying back their own shares. In the first 4 months of this year, the S&P 500 companies announced $665 billion of buybacks. That's the biggest start of year ever recorded. Last year, they spent over $1 trillion, which was also a record year. Let me explain what a buyback actually does, what it means, because this is a key idea. A company takes its cash, sometimes borrowed cash, and buys its own stock on the open market. This reduces the amount of shares on the open market, so fewer shares exist afterwards. Since earnings per share, or EPS, is calculated based on the public shares that exist, earnings per share goes up, so the price goes up, the price of the stock goes up. Nobody built anything new or sold a single new product. The company is not getting better or innovating, it's just buying its own stock. Some consider it market manipulation, allegedly. Actually, the SEC considered it market manipulation up until the early 80s when they randomly changed the rules to allow it. We'll talk about why in a second, because it's totally legit. It's like a band buying up their own concert tickets and then bragging that they sold out the stadium. It just doesn't make sense. And get this, they're doing it at the most expensive prices in stock market history, which sounds insane until you remember who signs off on the buybacks. Get ready for this. They're executives who get paid in stock. I mean, the buyback pushes the price up. They get their bonuses in stocks. Now you see why the SEC changed those rules, allegedly. So underneath this market sits roughly $1 trillion a year of guaranteed buying that doesn't even look at the price. The biggest buyer of American stocks right now is American companies themselves, and it has been for years, by the way. Oh, and while I'm talking about buyers who don't really care what they pay, there's the 401k machine too. Picture a nurse in Ohio. I don't know why I'm picking Ohio, but whatever. Every 2 weeks, $500 leaves her payslip and goes into a target date fund. And that fund buys the S&P 500 automatically. The money just buys every payday at any price. It doesn't matter what the price. Now multiply her by tens of millions of Americans on the same autopilot. Nothing wrong with that, by the way. Nothing wrong with what she's doing. It's probably a good way to invest her money. But the point is, a huge chunk of the buying behind these record highs happens on autopilot. It's a payroll setting. Now, to be clear, this is just how markets function. It's not anything crazy, but it explains why there is always some underlying buying pressure in the market. Now, let's talk about leg number 3, because this is the sneaky one, and that's inflation itself. I'll explain how it works. When prices rise, company revenues rise automatically. So imagine a pizza company. Same pizza's going out the door, higher price on every box, and the chart calls it growth because inflation is running at 3 to 4%. So a company can sell you less than they did last year, charge you more, and report record revenue with a straight face. So another example, your grocery bill went from $70 a week to $100. Their record revenue is literally just your grocery bill going up a lot of the times. Did you know that you were pumping the stock market every time you bought milk? And by the way, if inflation is eating into your savings and you want a proper plan for how to manage it and retire by 2036, I have a free guide for you. How to retire by 2036, there's a link to it below. Check it out after you finish watching this video. Also, when you grab it, you get signed up to my free weekly newsletter, which I'm sure you will love. Now back to inflation. The big money understands that inflation is a problem. That's why they don't hold a lot of the US dollar, because its value inflates away. So instead, they buy stocks, property, anything that's real. That's why record highs and $39 trillion of national debt keep showing up together. It's a feedback loop. One feeds off of the other. Now, the obvious question is, why is this whole machine running so hot right now? Well, it comes down to the midterm elections in November. Trump needs inflation looking tamed, even though it's getting out of control again. He needs the dollar looking strong, and he needs the stock market printing record highs for the headlines, because people vote on how they feel, and if the stock market is at all-time highs, it sounds like the economy is doing well, even though we've already said the stock market does not equal the economy. So that's why stocks are at all-time highs right now. But now is the most important half of this video. When does this whole thing collapse? Let's start with the government pump, the debt. $39 trillion. It's growing by about $7 billion per day. The interest the government has to pay out to holders of that debt is $1 trillion per year. The only way to keep this going is to print money and debase the US dollar. Short term, this is kind of good for stocks, but long term, it usually leads to something breaking. What about stock buybacks? We talked about those. Those have an expiry too, because companies are borrowing at record valuations right now to buy their own shares. And I do mean record valuations. The Buffett indicator, which is an indicator that measures the value of the whole US stock market divided by the GDP of the US. It's sitting at around 220% right now. So that means that the entire stock market is 220% the size of the GDP. And that is the highest it's ever been. It's higher than it was at the top of the dot-com bubble when it was about 140%. And that bubble took 49% off the S&P when it crashed. And the concentration risk we talked about, that's also important. This is where I want to tell you a quick story, because we have seen this scenario play out before. several times really, but I want to focus on this one time. So back in 1972, Wall Street fell in love with a group of stocks they called the Nifty 50. Xerox, Polaroid, Avon, McDonald's, Coca-Cola, the unstoppable American growth machines. They called them one decision stocks. You buy them, you never sell, and price doesn't matter because quality that good is always worth it. Sound familiar? Yeah, I mean, that's kind of happening right now. By late 1972, the market traded at a PE of 19. I'll explain PE in a second, but the Nifty 50 averaged 42 in PE. Polaroid was at 91 times earnings, McDonald's at 86 times. So what is PE ratio? PE is the price to earnings ratio, how much you pay for $1 worth of earnings. So the broader market, you paid $19 for $1 worth of earnings. That was the value of your average stock. But for Polaroid, you were paying $91 for $1 worth of earnings. Strong indicator that it is overvalued. Then 1973 hit, oil shock kind of like now, inflation kind of like now, a mess in Washington kind of like now. The world got screwed. And the Nifty 50 were taken out one by one. From their highs to the 1974 lows, Xerox fell 71%, Avon fell 86%, and Polaroid fell 91%. The whole S&P lost 45% in those 2 years. The worst crash since the Great Depression. And the guys holding the never sell stocks, they waited for over a decade to get back to break even if their company even survived at all, which some of them didn't. Today, Nvidia trades at over 50 times earnings, Tesla at 286 times earnings, and 43% of the entire index is riding on 10 one decision stocks that everyone agrees that you should just buy and never sell because, you know, AI is good and blah, blah, whatever. I'm not saying Nvidia is Polaroid, by the way, but honestly, in 1972, they weren't saying that Polaroid was Polaroid either, if that makes sense. Meanwhile, the actual economy underneath it is carrying $1.25 trillion of credit card debt. Savings are near record lows, and sentiment, like I said, is at 44.8, the worst ever, although it's gone up last month, but we'll talk about that in a sec. And 70% of American GDP is that exact consumer, the one with all the credit card debt that kind of feels like they're in a hopeless position right now. And all three of these legs, they run on confidence. When that goes, it goes fast, and you get no warning on that day. It just happens. The bubble pops. House prices started falling in 2006, right? But the crash came in September 2008 when everyone stopped believing in the same week. The gap in between where the data's terrible but the market won't drop felt exactly like right now. And the longer the free legs hold, the worse the ending, because another year of this means another $2 trillion of debt and more buybacks at even dumber prices. The delay just compounds the bill. Now, let me argue against myself for a minute, because I'd be lying if I called all of this a certainty. Could this run another year or two? Absolutely. Markets stay irrational longer than you stay solvent. And I've watched this play out over my whole career several times. I'm not calling for a crash next month. I used to do that when I was young, cocky, and dumb. I'm just saying that this has to come to an end eventually, and the longer we go without an end, the worse it's going to eventually be. Oh, and consumer sentiment, like I said, it bounced back in June from 44.8 up to 49.5, but that's just the second worst number in 60 years. So it's not like it's trending in a very good direction. It's still down overall. And some of you are thinking, Nick, if it cracks, the Fed just saves us. They cut rates and they save the economy, except we've run that experiment twice. In the year 2000, the Fed slashed rates from 6.5 down to 1%, while the S&P still got cut in half. In 2008, they went all the way to 0, and the market still lost half its value before it bottomed. Rate cuts didn't stop either of those crashes. They just softened the landing a few years later, really. And if AI actually delivers on the productivity miracle it keeps promising us, earnings grow into these valuations and the crash gets cancelled. But, you know, I don't really buy it. I think we're in another dot-com style bubble and it's going to pop one day. I don't think AI is as good as it's cracked up to be, and I work with AI a lot. Honestly, if you look at the market in the last few weeks, it might already be popping. The thing about a bubble pop is that you're not always sure it's happening until a few weeks or months in, sometimes even a year in. It's called the denial stage, the it will bounce back stage. But SpaceX is down 44%. Microchip stocks are down 20%. Maybe this is it. Maybe this is the start of it. Or maybe we do bounce back. That's the thing with markets. You don't know until you know, which is why I always say I'd rather be a year early than a day late, because being a day late usually means half of your money is wiped out. So no, I'm not giving you a crash date. I'm not saying to you it's going to crash on this day. Now, the main question is, what do you do when the future is so uncertain? I'll talk about what I do with my own money. This is not financial advice, by the way. It's just how I'm planning. And I've made some big moves this year. First, the biggest one. I sold most of my SPX, my S&P 500, from my active portfolio and also from my retirement portfolio, and I put a chunk of it into Poland, the WIG, the WIG. That's their main stock market index. It's the Polish version of the SPX, and it's worked out pretty well so far. It's up twice as much as SPX this year. I did a video on this a few months ago, and people laughed at me when I said I was doing this, but I'm up 20% while SPX is only up 8% this year. So now I'm the one laughing. I mean, literally I am. But why Poland? Because I learned a lesson in the 2008 crash because I invested through that crash. Back then I was living in Australia, watching the global financial system melt down from a country where not really much happened. I mean, we had boring banks, conservative lending, China buying every rock that we could dig up out of the ground. The world burned and Australia mostly just kind of watched it on the news. I mean, you know, the Aussie stock market was affected. It just wasn't as brutal as what the rest of the world faced in 2008. And that's when geography clicked for me. When the big things crack, some places get hit way less than others, and nothing's stopping you putting your money there. I'm not going to say Poland is going to fly up in a global recession. It certainly won't. It is going to drop just like everything else. I'm saying that it is more insulated from a massive crash, so it will probably drop less. That's why I'm starting to move my money over there. And it's also important to note that a lot of billionaires in the US are starting to move their money out of the US, not necessarily into Poland, just out of the US into Brazil in some cases and a lot of different places. Now the second move I've made this year, this is the money that I still have in US stocks. I've gone very defensive, consumer staples, utilities, energy, the most boring stuff on the shelf. And I say that with love, by the way, because I like boring stuff. Boring stuff saved my ass in 2008, in 2012, and in 2020. And I think boring is about to have another moment right now. On energy, I'm looking at names like Vistra and NextEra. Whatever happens to the AI bubble, the data centers already got built and they are hungry. Also, energy providers are providing energy to more than just AI data centers. People still pay their energy bills in a recession. Electric vehicles still need charging. The green energy revolution may slow down, but it won't stop. I am bullish on energy. Move number 3 is I'm holding more cash right now. More cash than usual. Long-term cash is trash because inflation eats it alive. We've talked about this. But short-term, it's my ammunition. It's how I buy up what I want to buy. And I'm not going on a spending spree either. I'm not going to spend it all in one shot. The greatest lesson I learned from 2008 is to have cash ready to buy the blood. So I have some ready. So yeah, the market is still pumping even though the world's going to shit. But it pumped right up until it didn't in 2000, in 2008, and every crash before it. All you can do is be ready for when it eventually crashes. There's a link below for my free guide to retiring by 2036. Check it out, and I'll see you in the next one.